You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Welcome back, Brandon. We've been doing a little bit of planning constantly over the past couple of weeks for our trip to the US. Are you excited?
I'm very excited. I've never been to the States before, so I'm extremely excited. I think it's going to be fantastic. But yeah, a lot of logistics. I can definitely understand like people like, oh, you guys going to the States? Oh, that's awesome. It's also like logistics. We have to figure out our content. We have to figure out, when we work on the trip, because we're not just going for a holiday. It'll feel a bit like holiday, but we also have to force ourselves to work while we're there. So try and figure all that out. Where do we go? The flights, the accommodation, podcast guests, this, that, the other, where we're going to be when. It's quite a handful to organize going overseas.
Yeah, it is. And then you just add this layer of COVID restrictions potentially playing a role and mandates and having this certificate ready, and there's just it's just a basket of things that we have to prepare. So yeah, it's certainly been a while since I've planned a holiday, so or a trip of any kind. So yeah, it is full on, but I think we're doing okay. We're not the most organized bunch. We'll be.
We're not. But man, I'm looking forward to it. It's going to be great.
Oh, yeah.
And Tom's coming now as well, which is just fantastic. So
yeah,
we're getting the team back together. We're getting the band back together.
The crew. Which
is kind of funny because like we know Tom, but we've never met him.
That's true.
Like in person.
Yeah.
So
it'll be good. No, I'm really excited. Yeah, we've got a bunch of things that came up this week. We've got some inflation data came out last week. Everyone's probably already seen that. The Fed had their meeting, I think it was last night, to talk about interest rates. So we'll talk about that.
Right.
Some news out of Starbucks in terms of their management team. And we've got a bunch of other things. I won't read through the list. You can see what's coming up. Maybe it'll be in the title, maybe not. But yeah.
It's some good stuff. We got some good stuff to talk about today.
Yeah. Absolutely. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically or you can do it one by one using Excel, or using Excel when downloading them from your broker. Super easy. And once you do that, it will basically track all of the different gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or hold foreign currencies. That's a big one at the moment with changes in interest rates and conflicts going on around currencies around the world are fluctuating significantly in relation to each other. So if you're Australian investing in the US, being able to track what is your loss or gain on that is super important, or regardless of wherever you're from. And then you can use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track performance, diversity of your portfolio, and used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, track up to 10 holdings, I believe it is, for as long as you want, or you can sign up to a paid plan, get more features, and get 4 months off a yearly subscription if you use our link. Thanks to everyone who's used that as well to support the podcast.
Yeah, definitely. All right, before we get our heads too deep into this inflation Fed interest rate stuff, can I start the podcast out on a lighter note? I want to talk about the One.
The One. Where have I heard that from?
Yeah.
Where have I heard that from?
You remember this is that mega property?
Oh.
In LA? The one that the Niall Niami tried to sell for $500 million.
That guy was a bit quirky as well, right? He did some
quirky.
He was a bit of an enigma.
Yeah, he was like, "What do you hope to achieve with selling this property?" And he was like, "I want to change the world."
Yeah, and he was saying it was environmentally friendly or something, and it's a mega mansion.
Yeah, that's right. We're walking through this like ridiculously oversized, well, on YouTube, we're walking through it. We're not actually walking through it. This hugely oversized cabinet, like these enormous rooms that are 5 times the size they need to be. And then he's like, look, we even put plastic flowers up because it's more environmentally friendly.
Oh, dear.
I was like, oh, really? Okay. First of all, I'm not sure I agree with that statement. But secondly, it's just like, how can you say environmentally friendly when you're standing in this flippin'
Ridiculous.
this house? But anyway, he for those that don't know, I'll catch up to speed. This is the biggest residential property in the world. He wanted to sell it for $500 million. Unfortunately, that did not happen. Nobody wanted to pay up. Nobody wanted to pay $500 million. But it has sold recently. So, Hamish Hodder, did you see how much it sold for?
No, I haven't looked yet.
No, okay. Yeah. Well, I want you to guess. How much did the one end up selling?
I'm trying to remember.
Mind you, I think there was over, just before you guess, there was over $250 million of loans for development on this property.
Wow, okay. Yeah, because I remember it had fallen, they'd knocked it down quite a few times.
It seemed like they kept halving it.
Yeah, so I'm thinking it's going to be quite low. But I don't want to lowball it too much. I'm going to say maybe...
It's over $100 million.
Okay. I was going to say maybe like 150 million.
Oh, you're not far off, Hamish. You're not far off. It sold at auction for $141 million.
Wow. Yeah, that's because I remember it went, it got knocked down by half, and then it must have got halved again. It really, that's crazy.
But then they're just, this is like a cursed property because they were trying to sell this thing at this online auction. It said something like, the auction that ended March the 3rd drew only 5 bidders, even though the auction site drew views from 170 countries, including Australia, UK, Germany, France, Italy, generated some 2,800 prospects in the days leading up to it. But just at the same time, I think the conflict between Russia and Ukraine started, so that they think that might have spooked away some of the buyers.
Right.
They just dried up. So they really ran into no luck. They had way less bidders than what they thought they would have, 141 million. And actually what's interesting is that 141 million is still like there's a lot of creditors that are not going to get paid back because they're still taking a massive L on this. And interestingly, interestingly, the guy that bought it, his name is Richard Sagian. He is the founder of Fashion Nova, which is the LA area fast fashion company. I've not heard of it, but apparently it is a very big fashion company. Interestingly, he might still be outbid because it was like foreclosure kind of sale. It's like they just want to take the highest bidder. Like even though he's won the auction, it's just like if someone bids high, we're going to take it because we want to recoup more money. So I'm like, okay, yeah. But also weirdly, Niall Niami, he actually had a personal claim to the debts as he personally lent the project $144 million. And his attorneys filed legal papers in bankruptcy court objecting to the sale to Sagian because he said that the winning bid was well under the $228 million appraisal of the property in 2019. He also argued that the auction was rushed and held amid the very uncertain times with respect to the Ukraine conflict and related sanctions. So it's kind of interesting that this guy still has a bit of a say.
Yeah, so he's put in quite a bit of his own money, even though he has used an enormous amount of debt. He has put quite a bit of his own money up in that. So wow, that's crazy. But I mean, I don't know what we've spoken about this before, but I don't know what he was expecting. I mean, how many people, that list can't be too long for people who can afford a $500 million house. Like it's got to be less than, in the US, it's got to be less than like a couple hundred people just in total.
Yeah.
And
definitely.
most of them are, probably not going to want a huge mega mansion with a nightclub in it and all these other things. So, yeah.
Because that's the thing with these properties, when you look at how big it is, people forget they're like, 141 million. Oh, there's plenty of people with net worths more than 141 million. But to keep a property like this going, to pay the related taxes, to pay the staff, to upkeep the grounds, to upkeep the property, it's like millions and millions and millions of dollars per year just to keep this thing running. Just to keep your house going, which is pretty crazy. But
insane.
There you go. We'll see what happens, whether it actually goes through at 141 million, because, geez, a lot of people would be taking 100% losses on a lot of creditors would be taking L's on that, but we'll see what happens.
Yeah.
But there you go. Another chapter in the story of The One.
The One.
The One.
Oh,
the
boy.
one that they wish never happened. It was such a nice hillside before. Why didn't we just leave it as hillside?
Why did we do this? Oh,
So that's my lighthearted kind of story to start the podcast.
Okay,
now we get into the dense
some
stuff,
heavy
don't we?
stuff, all right?
Now we get into the CPI, we get into inflation, we get into the Fed. Hamish, I saw a little bit of what happened. I saw the headline number. Tell us
Yeah,
about
so economists were pretty close the day before the numbers came out this time. So
it. We were pretty close. You were bang on.
I was bang on. I was gonna say something else though. I think I was gonna say 7.8, and you bumped me up to 7.9. Because you said that, I think, right? Because you said that it would be 8, and then they would squeeze, they'd do anything they could to get it just below the 7.99.
Yeah.
So
the Kentucky trimmed mean average of the last 7 days equals.
Yeah, exactly. Yeah. No, but yeah, so it came in at 7.9%, which is off the charts, highest in 40 years. The monthly increase was 0.8%. Which is the second highest monthly increase over the past 12 months. So there's been 2 months where there was a 0.9, and then this is a 0.8. So we're, if you look at the chart of even the month over month increases, it's trending up. It's not trending down. So that's obviously not what a lot of people expected, but economists are starting to come around. They're getting closer at their predictions. A few months ago, they were way off, whole percentage points way off. Now they're in the range. So expectations are kind of lining up, but a couple of big contributors drove a lot of that. Energy was up 3.5% month over month. These numbers are, which is massive. And that was primarily driven by gasoline, which was up 6.6%, and oil, which was up 7.7%. So obviously some massive increases from the energy sector. But it's also important to remember, as we spoke about last week, that most of the oil price increases that we're seeing now at the consumer level will come through in March. Most of that's happened over the past couple weeks. We've been in March, so
isn't that a scary prospect?
Yeah, and I think I saw last week economists are expecting 9% year-over-year inflation next month. So that's a big increase. Especially since we're now lapping quite high inflation from last year. So 9% over last year is massive. That's 9% over, what it was. It was already a 5% increase. So 5% plus a 9% on top of that, like compounded.
Jeez,
which is, when you think of it that way, it's kind of insane. So, yeah.
Yeah, where we were like a few years ago to where we are now is actually quite a substantial difference now. It's not just a 7 or 8% difference. It's, hang on, that's 8% the last 12 months.
Yeah.
What happened the 12 months before that? So yeah, I never really thought about it like that, but of course you should think about it like that.
Yeah.
If you rewind to pre-pandemic,
Oh, yeah.
prices are substantially different now.
Yeah, and of course, not everything. This is just an estimate of what prices are increasing by. That doesn't mean, of course, everything is just equally going up 8%. So there's areas of the economy where the rate is insane. I was just looking at Texas Roadhouse, which is one of my investments, a restaurant company, and they're penciling in 17% food inflation and I think 10% labor or wages inflation in the first half of this year. So, that, for example, the price of beef is one where the prices have absolutely skyrocketed. So there's some areas of the economy where there's some clear double-digit increases, which is massive. If that happens for multiple years in a row, we know what that compounding looks like because we're targeting like 15% returns in our portfolio. We know if we compounded 15% for 4 years, what are you at? You're a double, right? Or something like that. So, it can grow quite quickly. The Fed finally updated their inflation expectations. I've poked fun at the Fed a few times because for so long they've had their 2022 inflation prediction at 2.1%, which is just insanely low. That's not going to happen. So they revised it, and it's now 4.1%. So they've they've moved it up a little bit. We spoke about this at the end of last year, how throughout the year they just raised it a little bit. Oh, okay, man. All right, we admit it. It's going to be 4.5. Okay, it's going to be 5.5%. They just raise it slowly and slowly. So we're already at 2.1% in the first 3 months of the year. So whether the remainder of the year, the last 9 months, is going to be another 2%, I'll leave that up to the listener to decide if that's going to happen.
Yeah. Oof. Yeah, the Fed has just been... the Fed's just been wrong.
They've just been wrong for so long. And look,
they've just tried to downplay it, haven't they? And that hasn't really worked out for them.
Yeah, and that's economics. During stable periods, it's easy to project what's going to happen in the next quarter. That's why, everyone kind of relies on these quarterly data points. And most of the time, it's easy to project the next 3 months. If there's no volatility in the market, a company produces 100,000 units last quarter. Okay, they did a little bit better than the quarter before. Maybe they'll do 110,000 units this quarter. It's pretty easy to make those predictions on a quarter by quarter basis when things are kind of fairly normal. But as soon as there are unpredictable events happening, volatility, it's just impossible. Nobody knows what's going to happen. And that's why focusing on the quarterly data is kind of dangerous, because it seems like a safe place to live until there's stuff going on that we're seeing right now, like inflation, interest rates, and this conflict and a bunch of other things. So
yeah, projections, guesses, estimates, just don't listen to them.
Don't do it.
Just say, oh, I see your estimate, but I know that the market is unpredictable. Macroeconomic factors are unpredictable. And then just throw it out the back door. It's probably the easiest way to go about it, to be honest.
Yeah.
Honestly, I used to, a couple of years ago, I'd read a report like, oh, the Fed expects this. And I'd be like, oh, okay. So I kind of trust it more. But now I think it's a good thing now that for me, it's kind of instinctual that when I see economic predictions, it's like I don't even register it. Like my eyes just go, just gloss over it to the next sentence.
Yeah.
I don't care what anyone says anymore about what they think the future will hold in anything. Especially, I remember one of the big learnings that I had over the past couple of years was learning not to factor in price targets. Price targets from a JP Morgan might shift a stock, but in reality, you should just not even pay attention, because what you find is the stock goes up, they adjust their price targets up. The stock goes down, they adjust their price targets down. That's all it is.
Yeah, I think that speaks to how as time goes on, the more experience you have in the market really makes a difference, because it is one thing to learn about something in theory in a book. It's another thing to actually go through it and experience it. I feel like you learn a little bit more when you experience something negative than if
definitely.
You just read about it. Of course, you can learn things from just reading, but going through it and watching the Fed be wrong consistently for maybe 24 months now, it is a real eye-opener as to exactly what you said, that it's just who knows what's going to happen. I mean, a couple months ago, no one would have predicted that, maybe some people would have, but most people wouldn't have predicted that oil prices would be doing what they're doing now. And a couple of years ago, no one would have been predicting that they would have gone negative. So there's just so much uncertainty in those sorts of things. But that leads us to the Fed meeting that happened yesterday, I believe, or the day before. And the expectation was that the Fed was going to raise their federal funds rate, the official interest rate, up by 0.25% to combat inflation. There was a little bit of debate maybe a month or two ago of whether it was going to be 0.5%, a big increase, but that didn't happen. So 0.25 was the increase. It's the first increase in 3 years, and now they're targeting a range of 0.25 to 0.5. So they're targeting an interest rate within that range. They made a big announcement, which was that the Fed has now penciled in 6 interest rate hikes for 2022.
6.
So Yeah, that's much higher than the, I think, 3 that they said they were going to do in December. I think they said they were going to aim for a 3 interest rate hikes. I think one of the big investment banks in the US said maybe they'll do 4 or 5. I don't know anyone who was penciling in 6. So in terms of people who track this stuff and invest based on it, which is not us, but 6. So they hopefully by the end of the year, they're expecting to be between 1.75 and 2%.
Yeah, that's interesting. And I think the thing to remember here is that it's not necessarily the number of interest rate hikes. It's what percentage that will lead to.
Yeah,
so
that's true.
The question I have, and I just drew up a couple of charts while I was listening to you there, is, okay, we've got inflation at, 7.9% now.
Yeah.
And we're aiming to reach rates 1.75 to 2% by the end of the year. Is that going to do anything? I know we've touched on this before, but like, you really think about it, is that actually going to do that much to stop inflation? Because, and this is the example, this is why I got these charts up before. We're saying it's the highest inflation in like 40 years. Yeah. And if we rewind to the 40 years ago, I'm looking at the US inflation rate now. It spiked from about 5%. So we've crossed past through 5%, and it spiked all the way up to, it was worse inflation. It spiked up to 15% at its worst.
This is the late 70s, right?
Yeah, this is late 70s, 1980. And what Paul Volcker did back then is he didn't raise the interest rate from 0.25 up to 2%. He overnight put the interest rate at 20%.
Yeah, wow.
Now that action stopped inflation. Putting the interest, like going kapow, cop it, 20% interest rate. Yes, it did send the US economy into recession.
Yeah.
Yes, it was unpopular.
One of the worst recessions ever as well. Yeah.
Yeah, but it did work. But my question is, although it would be painful and although it would be brutal, if the Fed is raising rates to try and stop inflation, which is now at 8%, should they be raising rates by a lot more and in a much shorter time frame?
Yeah.
Should they do a mini Paul Volcker? Because inflation's not as bad as what it was back then, but should they do? Or you could argue that it is with your other with going with the old method.
Yeah.
But should there be just more decisive action and go, hey, bang, let's do this. Let's get it done right now. Let's not slowly ease our way into a recession over time. Let's just go bang, get it done.
Yeah.
Decisive action, stop inflation, get back to where we were.
Yeah. I mean, you would think that they would do that. I wonder if the US government debt is playing a role in this decision because, of course, as they have $30 trillion of debt and as some of those bonds roll over, they have to replace them with new debt. Like every responsible debt holder does when the debt comes due, they just get new debt and pay off the old debt. No, but that's what they do, right? And they use new debt as well, of course, to pay the interest payments as well, of course, because they can't do it all with tax revenue. Point. So if they have a massive increase in interest rates, that means that there's going to be a massive increase in those new bonds, the cost of those new bonds. So
yeah,
I don't know if that plays a role.
I think you're probably right.
I think
there.
Joe Biden had a nomination this last week or something. I didn't actually look into it, so I'm not sure. But he had a nomination for the vice chairman of the Fed. So obviously, I think the US government would be concerned of a quick interest rate increase. And I think that's what Charlie Munger was talking about, where he says, do we have a political environment that would allow something like that to happen? So
he said probably not. He said you probably couldn't get that sort of decisive political action today.
Yeah. And
it's probably not an environment where it could happen.
Yeah, and that's concerning because it's really the best lever that we have for reducing inflation. And yeah, you're right. We really don't know what is going to be enough. If a lot of the inflation we are seeing is still baked into supply chain issues that are just taking longer, let's say, to fix than was previously expected. So there's still an element, let's say, of transitory inflation that just wouldn't take a year. It's going to take 2-3 years. Then it's possible that only a small amount of interest rate increases is necessary. Supply chain issues will resolve, and inflation will kind of partly naturally come down. That's possible, but it's yet to be seen. And no one knows what's going to happen. And if it doesn't happen, then the Fed will have to raise interest rates significantly. And they're always going to lean. They're always going to lean. Use that as a last resort, because it's almost certain what happens if they do that. We go into a recession. Whereas it's not really certain what happens if they don't do that. If they just raise interest rates a little bit, maybe inflation goes away. Maybe it doesn't go away. So that up in the air, maybe it'll fix itself, is a better choice, at least in the Fed's view, than a certain recession.
That's a good point.
So there's that.
What else we got to talk about there?
Yeah, so there's a couple other things. So with the interest rate increases, Jerome Powell, the head of the Fed, says that he expects slower economic growth this year, of course, but no recession. So they're expecting GDP growth to come down from 4%, was the prediction, down to 2.8%. So growth is slowing down, but not negative. So no recession. And the reason for that is because they believe consumer demand is still very, very high off the back of the pandemic. The Fed said they'll start reducing their $9 trillion balance sheet next month. So they have $9 trillion worth of mostly mortgage-backed securities and treasury bonds that they buy from the major banks in the US as well as from the government to push money into the markets. They'll start winding that process back, so letting some of those bonds mature and not replace them, as well as actually selling some of those assets on their balance sheet. I mean, when I read this, to me, it's pretty bad news overall. There's more interest rate increases this year than expected. GDP growth is slowing down. The Fed's going to be reducing their balance sheet. None of this is really positive for the market at all. Plus, inflation was insanely high and still growing. But the market was up on the news, which is kind of strange. The S&P went up 2.2% and the NASDAQ was up 3.8%. And I guess the market was just they want to grasp to some level of certainty. Anything that's...
Just tell us what's going to happen.
Exactly. And I think that's why the markets have kind of been in free fall over the past couple of weeks, because there's just been left, right and center things happening and no certainty on how they're going to look.
Yeah.
But yeah, market conditions are not good. I would not have expected that move. I don't know.
Not me neither.
But whatever. Markets do irrational things. In fact, there was one stock that was up a lot. Do you want to talk about that one?
Yeah, I will talk about this because I think it impacts both of us. It certainly impacts my portfolio. And probably I've been talking about this stock a lot on the channel. And it's not just Alibaba. It's a whole raft of other Chinese stocks as well. But did you check your portfolio this morning, Hamish?
No. I mean, it's a very small position, so it's not going to have much of an impact.
So it probably doesn't impact you. Well, Alibaba went up 36.7% last night.
Crazy. Yeah. I remember it was
36.7%, Hamish.
Yeah, so one of my friends messaged me and was like, yeah, Alibaba's up 20% in pre-market. I'm like, what?
What? Yeah. Absolutely unreal. And it's not, I mean, Tencent up 23%, JD up 40%, Baidu 39%, Pinduoduo 56%. Holy smokes.
50%.
Neo 25%. So all of these big US listed Chinese stocks have just gone up, bang, overnight. And so I want to give a little bit of context because there's been a lot of uncertainty around these companies. Market perceived uncertainty. For context, Alibaba wasn't that long ago, about a year ago, it was at $250 per share, and it's just been declining over time. Got down to about $120 per share. Stayed there for a bit, and then recently it's fallen rather steeply, rather quickly down. I think it got down to like $77 per share.
Crazy.
Yeah. And it was down to a few things. So this was one of those events. We always look for events that tank stocks. But this was like an event on top of an event on top of an event on top of an event. So this was you can understand why it fell so far. So first of all, there was, of course, the mounting concerns that the Chinese government's cracking down on tech stocks. That's been going on for forever. There was concerns that China might cop some sort of economic trouble if they were found to be supporting Russia in the Russia-Ukraine conflict. There were delisting worries. as the US last week said that they were going to delist 5 Chinese stocks unless they handed over their audit data. And then there's now also more concern about another COVID lockdown in China. So there's like event. So it's like stacking essentially. So it was a lot of pressure. A lot of these Chinese stocks were feeling it. It wasn't just Alibaba. However, yesterday we saw a really big bit of news coming straight out of the Chinese state media, which actually covered, normally if you get some sort of news, it's normally, somebody saying something specific about one particular topic. But this was more broad. It was kind of like, we're going to do this, we're going to do that as well, we're going to do that, we're going to do that. So it was actually quite promising because they said a few things on a couple of different topics. So I've gathered these kind of bits and pieces from different news sources. So this is from Bloomberg. Quote, the government should, quote, actively introduce policies that benefit markets, quote, according to a meeting of China's top financial policy committee led by Vice Premier Liu He, the country's top economic official. That vow to take investors' interests into account comes after a sell-off in domestic shares due to fears over growth risks and tough regulation of real estate and internet companies. The meeting offered investors reassurance that a sweeping crackdown on internet companies was nearing its end, and they did actually say that they're going to wrap up they're going to try and accelerate their regulation stuff so that they can just get it finished and finalized and then move on. So people took a little bit of hope in that maybe this isn't going to be let's just prolong the tech crackdown for 10 years so that we can keep, smacking them whenever we want to. Yeah. They actually do want to get this regulation done and move on. China's banking regulator said after the meeting that it would support insurance companies to increase investment in stock markets. Then I saw on the Financial Times, it says, quote, China's State Council pledged to step up support for financial markets and the ailing real estate sector, vowing to, quote, boost the economy in the first quarter. And then over on CNBC, it said regulators from both countries are progressing towards a cooperation plan on the US-listed Chinese stocks, according to the Chinese state media. The report cited the meeting that we're talking about. So the government, and also noted that the government supports the listing of companies overseas. So there's like snippets here and there, but overall the takeaway is that the Chinese government has said, look, we're trying to support the markets and all of your fears, we're actually trying to, get on top of them quite soon, and we're not actually going to do anything that drastic. Yeah. That's kind of what the vibe was out of the report. I
guess they kind of had to do something to give some confidence into the Chinese market because, just looking at Alibaba and some of these other big companies, they had just been in absolute free fall for well over a year now. Well before really US stocks started feeling any pain as well, I believe. So, it kind of makes sense that they had to do something, and interesting to see from a number of different angles that they've kind of they've made some changes, or at least indicating that they're making some changes that are positive, but nothing too I guess what's the word I'm looking for? Nothing definitive. It sounds like easing worries, I think, in a couple of areas, but nothing that I would have expected such a dramatic rise. Although I guess all of those shares are coming from such lows. That
it's like any good news.
Yeah. and I mean, a 40% increase, or whatever it was, 37% increase in Baba, doesn't get it back to where it was a month ago or something like that? I don't know. Where was it about?
No, it's roughly the same. I was looking at, just on your kind of valuation point, I was looking at Alibaba the other day, had a market cap of like 200 billion and they have 55 billion in cash. So it's like God. I
didn't realize it was that dramatic. So, that's crazy.
No, so it's like the valuation was essentially like under 150
and billion. I remember, they have that third. Do they still own a third of Ant Group?
Yeah.
And people were valuing that at 200-300 billion, I think, or something insane like that. So it is crazy. It's a business that I don't understand, so I'm not putting more money into it. But if you understand these kinds of businesses, you should be looking at this company deeply. And I'm sure you probably have already if you're out there and you understand these kinds of businesses, because this is a very unique opportunity.
Make no mistake. I think, yeah, what you're saying is this company is extremely cheap. Like, it is extremely cheap. However, you have to be on top of all of the potential risks to feel safe making an investment in it.
Yeah.
But if you just look at numbers and you just look at discounted cash flow and you forget everything else, then yeah, it is very cheap.
Yeah, that's the thing for me. I don't think I have a good grasp of its business. I find it very complex. I like really simple, straightforward businesses. So it's a little bit more complex than what I'm used to valuing. It's a foreign company, and there's these other elements that I'm not quite sure how to quantify or think about. So for me, it goes in the too hard basket. I'm certainly not saying it's not going to do well, and because it's in the too hard basket, and it was so cheap at least from what people have been saying, like you're saying, 50 billion in cash or whatever it is. It incentivized me to put, I think it was 4% of my portfolio into it as a speculative investment. So yeah, that's kind of where I'm at with it, but we'll see. Yeah, it does, certainly from the surface level numbers and some analysis that I've done, like you said, it does look insanely cheap. I just don't know if I could put more money into it and be confident, just personally. But yeah, it'll be an interesting one to see what happens. I guess maybe we'll get some insight over the next few months, the next month or so, next 2 months, whether Munger put more money into them.
That would be interesting.
Because I think he doubled the size of the investment, right, at the start of the year or approximately that.
Yeah. So he doubled up.
Yeah, so he doubled up already when it was down over 100, 130, something like that. Must have been about 130 because that's actually when I put money into it as well. So yeah, it'll be interesting to see. It's fallen another almost 50%, or at least it had, from even there. So yeah, crazy story. And I guess we'll see.
Hey, guess what their free cash flow was in 2021?
I have no idea, but they're a massive company, so it's more.
So I was just telling you, market cap was 200 billion.
Yeah.
55 billion in cash on the balance sheet.
Yeah, I don't know, 20, 30 billion or something like that.
Yeah,
that'd be my guess.
30 billion in free cash flow in 2021.
Wow, okay. And they're at 285 billion in market cap. So if you take the cash off, 230, yeah, you're less than an 8 price to free cash flow.
And Hamish, yesterday it was 36%. That market cap was 36% less.
That's a good point. Where was it yesterday? Yeah, so it would have been even. Yeah, wow.
It was like I'm not kidding. The market cap was like $200 billion yesterday.
That is insane. Especially considering it's not, I mean, an 8 price to free cash flow with a bunch of cash on the balance sheet, that's good for a company that might not grow all that much. I mean, if you find a company that can grow at a couple of % per year, they got a bit of pricing power, maybe a Coca-Cola has a bit of pricing power, they can raise their prices consistently. That's what you're looking for in terms of a price to earnings. But yeah, for a company that's probably, well, I don't know what it's going to grow at, but most people are projecting somewhere between 10 and 15% at least for the next few years, or maybe more. Yeah, crazy story. I think we'll see out of Alibaba over the next 5 years. It'll either be the worst investment decision of a lot of people's lives because it looked attractive and it had all these elements, but a sledgehammer hits it, or it will be the most insane and maybe looked back as the most obvious investment opportunity for value investors in many years. I think it'll be one of those two things.
No, I don't disagree, to be honest. Anyway, should we move on? You want to talk about Starbucks? You've looked into Starbucks previously.
Yeah. So
we've spoken about Starbucks not that long ago, right?
Yeah.
That's right, because you were talking to me about was it the executive compensation?
That's right. Yeah, I put together a video a couple weeks ago, I think, where I kind of dove into the management's executive plan because there was some interesting things going on that you might not notice if you don't nerd out and dive into the proxy filing and read how these managers are being compensated and who's changing the compensation plan and what adjustments they're making to them over time. Because
as a quick recap, what happened there? Just like a couple sentences.
Yeah, so
I forgot.
So there was a change in management from Howard Schultz,
Yes.
who'd been at the company for 35. He's basically the founder, even though he didn't actually found the company. He bought it
Yeah.
from the founders a long time ago. Change of management to Kevin Johnson, who came in 2017, I believe. He changed the compensation plan, and he changed a couple of key elements. One was he removed the return on invested capital factor. So basically, how efficient he invested didn't matter anymore.
So it could just be rubbish.
Exactly. And the other one, he added a total shareholder return factor, which is total shareholder return is his compensation is affected by how much dividends are paid and how much the stock price increases, which can be driven by share repurchases.
And that's what he did, didn't he?
And then, he basically took on, I think it was $16 billion in debt over a couple years, and in total repurchased or returned to shareholders $25 billion, which benefited shareholders greatly. The stock price surged, a lot of dividends were paid out, but his compensation was maximized. He made he had a 40% increase in his compensation in 1 year. So he benefited massively, and I just wanted to point out the point that while yes, what we've seen so far from Starbucks, shareholders have benefited. In order for those share repurchases and the debt to not be overwhelming in the company, the business fundamentally still needs to grow on an underlying basis, and that's yet to be seen. So whether this is a terrible decision that only benefits the CEO, we'll kind of see how Starbucks grows over time and whether that impacts that. But
former CEO.
Former CEO, correct. So he's stepping down to retire. So he's moving into retirement, which is...
Are you serious?
He's retiring. No. Hang on. This isn't even the best bit either. So he's retiring.
Okay.
He's retiring from... So he's stepping down and retiring after 7 years. Funnily enough,
That is so Dodge. What the heck?
It's actually the second time he's retired in the last 8 years. The last company he was the CEO of. And I don't know if this even means anything. I couldn't find anything in the compensation plan that said if you're retiring, whether there's a special package you get. I don't know. I'll be honest, I don't know. I couldn't find it. But it's just kind of strange. He was the CEO of Juniper, and he stepped down as CEO in 2014 again, and he retired. He retired in 2014, and he came back in 2017 to work at, or 2016 to work at Starbucks. So I thought that was kind of funny. But during his while he was leading Starbucks, revenue increased from 22 billion to 29 billion. So, somewhat of an increase in revenue, and it's difficult for a business like Starbucks to grow. I think they have 30,000, maybe even more stores or locations around the world. So they're a massive company, very difficult to squeeze more efficiency out of them anyway. He returned $25 billion to shareholders through dividends and share repurchases, as I mentioned. As I kind of said just before, he after Howard stepped down from the board, he adapted the compensation plan to kind of suit his own needs. And I just keep reading this article and it just keeps getting worse. I opened the article thinking, I'm going to give this guy a chance. I'm not going to be harsh. Like, I really thought, let's not get angry, because I've gotten angry on this topic a few times.
Hamish is going to get angry.
I'm going to get angry. So apparently he had known that he was going to retire for some time. So it wasn't kind of a spur thing. He had kind of planned it for a while. And that's kind of funny because last year he tried to change the compensation plan again to give himself a $2 million one-time bonus. And
just cause
shareholders rejected it, which good on you, Starbucks shareholders.
Yeah.
I'm proud of you for that one.
Why'd you vote for the first compensation plan, you ding-dongs?
Yeah. Very, very, very funny. Also, I went back and looked at the compensation plan because he said he'd been planning on retiring for a while. I went and looked back at the 2019 was when the compensation plan was changed 3 years ago. And I actually missed one change. Another change he made was he moved when the shares vest on his compensation from 4 years to 3. Conveniently,
Smart. What a smart guy.
fully vesting in 2022. So, yeah. But the good news is Howard Schultz is coming back. So he's back for the third time.
Hey.
He's back for his third stint, and he's not expected to run the company long term. He's just expected to kind of calm investors down because the stock has been collapsing, of course, with everything that's happening, especially inflationary pressures in the business. Employees, there's a lot of discussion about unionizing employees at Starbucks. So there's just a lot of concerns from the employee direction of not getting paid enough, not wanting better conditions, from the investor side, worrying about inflation and labor cost increases. So there's just a lot of concern around the business at the moment. So yeah, Howard's going to come back and kind of calm everything down, and then hopefully find someone to run the business long term. But yeah, I just thought that was hilarious that this guy retired twice in a decade. Will he work again? That's the question. Do you reckon where's he gonna go next?
Where's he gonna pop up next?
Give him 18 months and he'll be running McDonald's or something.
Dear. Yeah, that's kind of ridiculous, isn't it?
Yeah, I don't, because it was kind of funny because when I first saw that he had retired from his previous job, I went back and looked at his other jobs before that, because he has a track record of working a few years at a lot of companies, and I was looking to see if he had retired from those companies as well, and I was also looking to see if that meant anything special in the compensation. I couldn't find it, but it was just kind of funny to see that. He's retired from his last two jobs now. He sits down and then he needs to get back into work, which, that's probably what actually is happening. But yeah, it's just funny.
What a guy. Anyway, Howard Schultz, he'll take care of it.
He will. I love Howard Schultz.
So he's just going to be like a caretaker until they find someone else.
Yeah, exactly right.
Okay.
Yeah.
There you go. Oh, well, I'm sure that will calm investors, at least to some degree.
Yeah.
Having Howard back, so I guess we'll see what happens there.
Yeah, I mean,
they didn't give any inkling on who might be next. I guess that now they kind of start looking.
No, and I mean, Starbucks still could have an opportunity to grow. They're still expanding into China, and there's apparently quite a bit of demand there. So there's still room for them to grow, which is insane because they have so many global stores. But it is an extremely powerful brand. Besides what management's doing and their decision making, clearly it's a powerful global brand, and even in regions where it's not super popular culturally to go to a Starbucks, they're at every single airport. Massive spread across the US and a lot of countries. They're starting to come back in Australia a little bit. They tried a decade ago and had to shut down the stores that weren't performing during the global financial crisis, but they're creeping back in. They have a few stores, so. It's an amazing. I think it's clearly an amazing brand. They clearly have some competitive advantages, and we'll kind of see how they can grow from here. Whether it's probably just going to have to be from store expansion, I guess. Pretty difficult to squeeze even more out of each store, especially when they start to kind of stack on top of each other. It's a big problem they have in New York is they have so many Starbucks stores that they kind of cannibalize each other a little bit. And the revenues at each store actually start to go down rather than up. So, yeah.
They should do something innovative. I think they should have lent into the idea, how everyone's like, I'll go take my laptop if I'm a writer or if I'm, want to work, I can go work at a Starbucks. You kind of get that vibe and that culture. They should have lent into that, and they could have been like the modern day. They could have turned Starbucks into like WeWork, yeah, where they would have had they could have maybe branded it as something like Starbucks workspaces or something like that, where they have a central Starbucks coffee at the bottom, but it's also like a WeWork, like a multi-level different area workspace, and you can they could have done something interesting, had a membership, a Starbucks membership
Plus.
where you could come in and swipe your card, opens the door, you got the Starbucks store right in front of you, you go into some nook or cranny, you get the nice Wi-Fi, you've got a nice comfy chair, and you can work there for the day.
Free coffee. That could have been interesting. Free coffee or something while you work there.
Yeah, something like that. Yeah, because you got the membership. I mean, that would have been interesting because it's kind of something that their brand became known for.
Yeah.
It's like going to work at the cafe, you work at a Starbucks, and you sit there for 8 hours doing your work, and you just have coffees. So I don't know, something like that could have been interesting. But I think, Starbucks is obviously known for coffee, but I wouldn't mind them doing something innovative, just trying something. If they got the cash to do it, I mean, do like an Amazon, just give a couple $1 million into some different ventures and see what different ideas and see what kind of comes through. Maybe none of it happens, but at least you've tried. If you want to reach that next tier of revenue growth, you need to find something different because clearly coffee is, like what you say, if you go to New York and you've got a Starbucks on top of a Starbucks on top of a Starbucks and then growing the stores doesn't work anymore. So that'd be interesting.
That's the difficulty with these mature businesses is they don't want to, shareholders kind of invest in these companies expecting nothing to kind of change. They kind of want this, they look at the cash flow, they want that dividend to come in every single quarter, they want some share repurchases, they want some efficiency improvements, and that's it. They don't want someone to come in, most of the time at least, and say, hey, we're going to cut the dividend and bet on this new venture that may or may not work, which is ultimately what would drive growth in the company. But it's just how it kind of works. We're seeing the same thing with the legacy media companies. It's difficult for them to commit to putting a lot of money into exclusive streaming content because they're giving up all of these these cash flow streams that investors have had and expected for so long. And I think it's why Netflix is just going to crush everyone. Disney's the closest out of the legacy media to really commit a lot of money to streaming, but it's going to be difficult. AT&T's not going to cut their cash flows just to bet on streaming.
Just try something.
And it'll ultimately be the demise of them, which is kind of a funny full circle, but that's the way it goes with legacy businesses.
It is the way it goes. Yeah, you're exactly right. So maybe that's would go down poorly, but I don't know.
I would like them to do that.
I think the way we invest, we like to see internal reinvestment, trying different things, getting to that next tier of growth.
Yeah.
But you're right. For the average, 60-year-old
pension fund,
they just want just do the same thing, do it a little bit better, make a little bit more. We're happy.
Yeah, exactly.
Don't stress us out. Don't make our analysts have to look into the streaming sector, or don't. We don't want that kind of extra workload. We just want to knock off early on a Friday and go, you know what, Starbucks is doing all right, isn't it?
Yeah, exactly right.
Exactly. All right. Should we do some Q&A?
Yeah, let's do some Q&A. What have we? Okay. Let's have a look.
We got a few questions. How about I want to ask this one to you. I want to see what your thoughts are on it. So how much time do you spend looking at cash per share? I'm holding a lot of airline companies that are pretty suppressed right now, but they're still holding a lot of cash relative to the share price. So how do you kind of think about cash in the valuation process, cash per share, cash versus market cap?
Yeah, that's interesting. So cash relative to, I think of cash in two ways. One is when I'm looking at the financial health of the business. So, and I'm not looking at cash in isolation, but I'm thinking about cash and the other short-term assets they have in relation to liability. So that's kind of the first way I'm thinking about, how much cash do they have to cover these obligations that are coming up? But more importantly, I guess, well, not more importantly, but probably more to the question is in terms of valuation. I think of, and I've probably said this analogy quite a few times, but I think of cash on the balance sheet as if you were buying a house and there's a chest of money buried in the backyard, right? If you're buying a house and you're willing to pay $100,000, but you know that there's $20,000 buried in the backyard, you're now willing to pay up to $20,000 more for that property, because as soon as you buy it, you can go into the backyard, dig it up, and get your cash back. It's like the cash on the balance sheet is a discount to what the value of the cost of the property is to you. So that's the way I think about it. I think of cash as an immediate cash flow that happens at day one. So I will subtract it from the price or add it to the price I'm willing to pay for the stock, or subtract it from the valuation, and then do the opposite in terms of debt. So debt is kind of an immediate cost I think of. So that's the adjustment I do. And what that's called is you're adjusting the market cap, which is essentially the price you need to pay for the stock, right? You're adjusting the market cap by cash and debt, and you get to enterprise value. So you can compare the valuation you have to enterprise value, or you can make the adjustment on the valuation and then compare it to market caps. That's what I do with the cash.
Nice. Yep. I'm the same. Yeah. Just factor it into your valuation. I always think about valuation as if I'm buying the whole company. So it makes it quite easy. I don't actually look at like cash per share because I'm thinking about valuing the whole company. So I'll just figure out what market cap I would like to buy it for and then factor in the cash off the market cap.
Yeah. Okay. I'll ask this one to you. I haven't seen Phil Towns' name come up in a while. It's been a little while.
Phil. He's gone off the radar a little bit. Good old
has he?
Phil.
Yeah, that's probably why. Yeah.
I think he's still making content, but I don't think maybe he's not super focused on it anymore.
Right.
I don't think his videos really take off like what they used to. I don't know, but anyway.
Yeah. Anyway, the question is, hi Brandon and Hamish. Not related to this episode, but have you come across anyone else who has a toolbox similar to Phil Towns? Hamish, your spreadsheet is awesome to use. Oh, thank you very much. But when I want to quickly look at a company, I use Phil Towns' toolbox, but his only does US companies. Really appreciate the great work you both do. I presume you're probably Australian, given the way you phrase that. So what do you think?
Yeah. I don't know. I don't think I've come across another for those that know and have read Rule 1, the toolbox is essentially just like a bit of software that must just scan all the US based companies and kind of nicely puts it into a table of all the things that you need to know from his Rule 1 approach, like the EPS growth and equity growth and all that stuff and return on invested capital, and it just puts it into a table. I haven't found anything else that's similar to this. I think probably the closest thing I would do is just go to QuickFS. Because QuickFS, they have 10 years worth of numbers and they'll tell you like what the return on invested capital average has been over time and what the EPS growth and the equity growth, revenue growth, free cash flow growth, it will tell you what those numbers are.
Yeah.
But no, I haven't found like a bit of software that's like fills in all the gaps. I find that it's a bit of a scouting exercise.
Yeah. Yeah. No, I haven't. I haven't really found anything else either. I'm not a huge fan of using scanners or screeners. To be honest, I prefer.
I don't know if I can trust them half the time.
No, and I mean, you're going to miss businesses where there's maybe an abnormal number and there's a good reason why that number.
True, yeah.
I mean, earnings per share might be negative in 1 year, and this happened to Facebook, for example, because they had to pay a $5 billion fine or something like that, right? Or earnings per share is much lower than it was previous years, but you might just take that fine as a one-off. You might not, but maybe you do. And if you do, then you want to add it back to earnings. So then the screener would miss that. The screener's not doing that adjustment. So I just much prefer to think about the areas that I understand and just look for great businesses in those areas. And if you're screening companies, what I've fallen into the trap of doing as well is you find businesses that look cheap on a number basis, but you don't understand the industry. You know that you don't understand the industry or have any hope of understanding it, but you kind of want to because then the broad numbers say it should be cheap. I'm sure a lot of people are probably doing this with Alibaba, for example, where everyone's saying it's cheap. Maybe you don't understand the business, but you kind of trick yourself into thinking I can understand this kind of business. And that's what you want to avoid. And I think screeners can do that a little bit to you. It can bias you towards companies that you don't understand and that you shouldn't form an opinion for or against. But no, I haven't really found anything good like Phil Towns' toolbox or anything similar at all like that, really. Yeah, no.
Yeah. Should we do one more?
Yeah, what have we got?
This one's addressed to you.
Okay.
I don't know if we've done this one already.
Yeah. Yeah.
Did we do that
I'm not sure. I'll give a brief answer on it, but yeah.
Okay. So the question is, hey guys, thanks for the great podcast. Been a keen listener for over 2 years now. Thanks very much for tuning in. My question is to Hamish. How are you thinking about ASOS? Has your thinking changed since you made the investment?
Yeah. So yeah, I think. Yeah, so the brief story behind this is I started looking at it because Nick Sleep is invested, or at least he has at some point invested in ASOS. So I invested I looked into the company and I found it really compelling from a management perspective, from an economic perspective, from a valuation perspective as well. And then I think I invested a little bit of money, not much. It was a very toe-dipping investment. And then I think 2 days later, the CEO stepped down. I have this really I have this terrible track record of investing in companies. And then the CEO who I really like either steps down or passes away or
dies.
I mean, it's
bad omen.
So look out, Reed Hastings, the CEO of
you got a target on your
CEO
back.
of Netflix.
Oh my god!
He's got about a couple weeks to live, according to my track record. I can't even remember where I was going with this. Yeah, so that changed the story for sorry, Brandon.
Sorry, I've lost it. The CEO of my company's either steps down or dies. It's unfortunately true.
It's happened 3 times out of I think 4 or 5 investments. So it's a pretty high strike rate. So that obviously changed the story around ASOS. I like to see a big track record from the CEO. So I like to invest in companies where the CEO has been in place for 5+ years usually. And obviously that's not the case if the CEO just stepped down. So I'm waiting to see the new CEO. We still don't have one. I think we're supposed to get the announcement over the next month or so. Although I think I said that last month and it still didn't come out. So we'll see what happens. But I want to see who the new CEO is. Did they work at a previous public company? Can I look at their track record there? And that will give me, then I'll make a decision about whether I still like management team. But that's where I see, it's up in the air. I'm not adding to it, even though it's really, really cheap if the management team is great. But I'm not adding to it.
It's a bit of an unknown at the moment.
Yeah, it is.
There you go. And I, like Charlie Munger would say, have nothing to add on ASOS. So there you go. All right, well, let's wrap things up. Yep. Thanks guys for submitting your questions there. And as always, head over to the YouTube version of the podcast. If you want to ask a question for Q&A, just drop us a comment. We'll chuck it in the Google Doc and we'll run through them next week. So much appreciated for your questions, guys. And of course, much appreciated. Thanks for tuning in and listening to us ramble on for a good solid hour each week. We do appreciate it. Yeah, we were always wondering whether we'd actually get anybody listening to us because we knew that this was just going to be rambling each week, just us chatting about stocks and just seeing what was going down in the world of finance. So it was kind of, I don't know, it made me feel good when other people actually found it interesting and wanted to stick around and listen. So yeah. But yeah, we definitely value your time, guys, and we value your support over the years. And I think that'll just about wrap things up. Hope you enjoyed the episode. And thanks, Hamish, as always, for joining me.
No problem.
And thanks to Sharesight, as always, for sponsoring. And we'll see you guys next week.
See you guys.